Hi, everyone. Welcome to another edition of Treece Talk. I'm Robert Wroblewski. And before we dive in, just want to take a quick minute to think about all the things that are going on in this world and how we feel like this nonstop political news cycle may be getting us down. Well, it can be distracting, but I've been reminding myself to stay grounded, focus on what I can control, and keep showing up with intention and purpose. David has a great Treece Talk prepared for us today. And part of our business philosophy is rooted in good karma, advocacy, compassion, inclusivity, accountability, and loyalty. We act as fiduciaries, which means we're committed to putting our best interests aside for your personal best interests, especially when the world feels uncertain or overwhelming. And our next Trees Talk will be on Thursday, August 21st at 10 a.m., where we'll introduce an exciting new service from wealth.com and dive into legacy, estate planning, and generational planning. It's going to be a great session. Put it on your calendars now. And David, over to you.
Thanks, Robert. I love the intro. The idea that we are fiduciaries, we always do what's in the client's best interest and no conflicts of interest, loyalty. All of that's super important. It's like golden rule stuff. I was just asked to write a blurb for a book that somebody's written along these topics, and I should have written this book because I totally agree with it. It's like you want to establish relationships with people, advocate for them, lifelong relationships, and that's what our practice is about. Well, I'll jump right into it, and I've got a lot to cover. We are talking today about the so-called One Big Beautiful Bill and what that means. We've actually discussed this, our team yesterday, that if there's enough interest, we could do a separate standalone presentation on it that would be recorded and people could watch it at their convenience. But I'm going to go through what some of those provisions are. There's a lot of information out there just about the provisions, but I'm going to, as I'm prone to do, make some comments about the effects of these. And so me and my big mouth commentary. And then I'm going to talk about some of the biggest news, which is that we had this jobs report. We have this question about will interest rates be cut coming up as soon as September, some GDP numbers. So I'm going to talk about all of that. And again, if you've got questions or comments, please don't hesitate to put them in our chat. Or if you want to do it privately, reach out to us too. You can email us team@davidtreece.com or david@davidtreece.com. On the One Big Beautiful Bill, these are some of the major features that have been enacted into law. One is the standard deduction is being increased again. So for married filing jointly, the standard deduction is 31,500, which is sizable. So what that means is most people have not been able to itemize their deductions. So that can, in some ways, make things less useful, like charitable contributions. So that's all the way up now to 31,500 joint, $15,750 single, and it's indexed for inflation. So every year that should be going up, and this is permanent. So this is. I point that out because other things that have been added are not permanent, and I think people don't grasp that. Not only are they not permanent, they're very short term. There's a senior deduction that's been in the news a lot because they were trying to, the Trump administration was trying to pawn this off as eliminating taxes on Social Security. And they kind of got busted on that one. But for somebody who is 65, in a certain income range, there's a $6,000 additional deduction. But that is also 3 years, 2025 through 28 only. One of the interesting things about these tax cuts, if you will, is that once they're enacted, if they expire, then it becomes what's argued as a tax increase. Effectively, it is. And that's one of the reasons why the other thing that we just had, the biggest change, I think, is the previous tax cuts were now made permanent. So they were set to expire at the end of this year, 2025. And so the biggest change is that those tax cuts from the first Trump term have been made permanent. And so there's some inflation adjustment at the lower tax brackets. So that will help lower income people, which is kind of different from a lot of the other tax breaks. But so that's something I bring that up because now you have the senior deduction that's very temporary for 3 years. Will that continue? Will there be political pressure to keep that $6,000 senior deduction? Somebody could argue, younger people, that wait a minute, older people have had so many advantages. Do they, and the cost of Social Security, they get another $6,000 deduction. Um, we'll see what happens in 2028 when that's set to expire. There is, again, permanent alternative minimum tax relief. People who have various sources of income, including investment income, would still have to pay certain alternative taxes. That helps middle and upper middle income households. So that was also set to expire. And now that has also been made permanent. There's an estate tax exemption. I always like to point this out because people aren't really aware of it, that it was $13.61 million per individual. So double for married couples. Now it's $15 million and it's also indexed for inflation. So what does that mean? $15 million is free of estate taxes, or $30 million for a married couple. And what that means is, especially with all of the tax planning that can be done, taking things out of estates, putting them into trusts, then you can avoid estate taxes altogether. The number of people who pay estate taxes, or as is sometimes referred to politically as the death tax, is very, very small. The vast majority of people are not subject to any kind of an estate tax because their estates are far less, or those who are ultra wealthy can make them far less. Um, there's a SALT deduction cap, SALT meaning the state and local taxes, that's raised to $40,000 from $10,000 for incomes that are under $500,000. So that's a tax break that's going to help people who have higher incomes, but still less than 500,000. And there is they had reduced that to just $10,000, and it's for if you're living in a high tax state, California, New York, you would hit that cap. Now that cap is higher, so in some ways that helps people who fall into that situation. There is a tax break for tips and overtime pay. And in the past, this has always been taxable. You're always supposed to report whatever income you make if you are a US citizen, even if you are abroad. There'll be tax treaties. You can do, double tax returns, but now that is tax free. Again, this is a very temporary position. It is a provision. It's just from 2026 to 2028, 2 years, basically. Will that continue, or will there be, more pressure to, balance the budget? Let's say there's a child tax credit that just went up $200 from 2,000 per child to 2,200, and that's also that one's permanent increase beginning next year. There are a few other things. One of the things you can see here is that these are largely tax cuts and are making permanent previous tax cuts. Of course, there's still a lot of spending in the bill, which we're not talking about here, but there are projections of this really increasing the deficit by trillions over these next 10 years. And so when we talk about these individual provisions, there are effects for these provisions. How will this affect the deficit? Will that mean that we'll have more problems in the bond market, that we will have a higher percentage of the federal debt that has to go to pay interest payments and the federal budget every year? And will that affect inflation? There are a few other things here: Trump accounts for newborns, $1,000 federal deposit for babies born 2025 through 2028. This is a provision that you would think, again, it's very temporary, 3 years. Um, these are like spending or giveaways. So I'm looking at the rhetoric around this in the political spectrum. If the Democrats had done this, like student loan debt forgiveness, it's a giveaway. And it depends on who's trying to curry favor with the voters, I guess. Um, on those so-called Trump accounts, you always see things kind of named, like the when the checks during the stimulus checks were sent out, it was signed by Donald Trump during COVID. So there's some definite political marketing involved here. So those will be interesting accounts to see how much they are used, and what the amount of participation is, and how it will be going forward. So those are some of the biggest provisions. I think the biggest things that people are going to see have to do with other provisions in here. They are, for example, cuts on the subsidies for Obamacare, not across the board, but some people, when they are trying to calculate what their income is going to be, to see whether or not they will get a subsidy to cover the cost of their health insurance. If they don't have group insurance and they're on the Obamacare market, before 65, before getting Medicare, then we're going to see some increases there. And I think those people are going to be shocked to see, wow, my health insurance premium effectively has gone through the roof. And there have been so many cutbacks in Medicaid spending. And that's also going to affect the rural areas more than other areas, which may be the opposite of the intended effects. So we'll see. We've already seen some hospitals in Nebraska in particular saying that they're going to be shutting down. People will have to go further to get those medical services that they need. The Corporation for Public Broadcasting is all of the funding 100% gone. That doesn't mean that these local PBS and NPR stations will disappear, but a huge source of their funding is gone. And again, that will affect rural America more than urban America. And some rural districts really rely on this information more than other places, just by the nature of less media competition. And also for emergency broadcasting, that's been an issue that's come to light also in Alaska, like if there's an earthquake and tsunami warnings. So that there's a lot of effects from this over the years, not just these tax provisions that will affect us when we do our tax returns. Now I want to shift gears to there's just a lot of economic news, so I want to cover some of that. We had an enormous rate or revision in the job growth numbers from the Bureau of Labor Statistics. One thing on this is it's been in the news a lot because these were admittedly gigantic revisions, way beyond what is normal. There are always revisions. And so it makes the job market look like it's really weak. And so a lot of commentary has to do with the fact that the Fed has been very slow to cut interest rates. Part of that has been because of inflation is going up. So here, Donald J. Trump, I can't say tweets exactly, but he posts on his Truth Social, Jerome, too late Powell, a stubborn moron, must substantially lower interest rates now, all caps, now. Continuing in all caps, if he continues to refuse, the board should assume control, like a coup. Does that sound familiar? January 6th. And do what everyone knows has to be done! Exclamation points. Excuse my snark. There's just sometimes you just have to laugh. Um, of course, the rules don't allow the board to necessarily just take control like this, and they're trying to be responsible and balance the inflation issue, and the tariffs are generally considered inflationary. So that's what they're looking at. And inflation is still an issue. It's still above what we want, and it's still gone up. And there's a lot of thinking that inflation is still not fully registered in in the economy and in how we're measuring things. So that's an issue. Now, having said that, this revision shows how weak the job market has become. So now we see that the the market is pricing in over 90% that there will be a rate cut in September. There's no meeting this month, so there could be a rate cut, like an emergency one between meetings, but that generally does not happen. It'd have to be something extreme. But right now, because of this, the market is finally starting to price in for a 90% chance of at least a quarter point rate cut in September. That could be good for the stock market. That could be good to stimulate the economy. That could be bad for inflation because all of that it could increase inflation. Now, here's something surprising. I said back last November, so we're going on, the better part of a year, probably three-quarters of a year ago, that there's not going to be any rate cuts because of all of the tariffs and the tax cuts. All of these things are inflationary. They stimulate the economy. And then the spending too. So all of this is going against the inflation, and the Fed's number one job is to control inflation. Second is the job market. So here, the markets were predicting 4 rate cuts. So here we are in August, getting into September, not a single rate cut. And I think that we are going to see it's an open question. It's going to be based on what data continues to come in. So here, bond traders, prediction markets, traditional data all point to rate cuts starting as soon as September. This is from Phil Rosen at the Opening Bell Daily. I follow him on his daily newsletter. But here, listen to this. Strategists at the Bank of America and Morgan Stanley told clients they do not expect a single rate cut, at least until next year. Even after Friday's dismal jobs data, which showed that the U.S. added just 73,000 jobs, far weaker than expected. So you see the markets through the futures markets pricing in a 9% chance of a rate cut, and yet 2 big banks are saying no, there will not be rate cuts because they're thinking the other statistics are not in favor of a rate cut, particularly inflation. Morgan Stanley argues that the labor market has softened, though its team argues that inflation remains too sticky to justify rate cuts, and also the effect of tariffs. So we still have more tariffs, the effects of tariffs still yet to be seen. So that's just an interesting take on this, that you've got extreme points of view. Also, here is a third extreme point of view. Goldman Sachs has reiterated its view just yesterday that the U.S. economy is near stall speed. So the Fed will deliver 3 rate cuts in a row starting next month. So 2 big banks say no rate cuts until next year. Goldman Sachs, September, October, November, at least 3 this year. And again, they're saying that based on the jobs market numbers. So it remains to be seen. We're in interesting times, and not just politically, but economically in terms of the data. But it's been this way most of this year, where you've had the stock market reacting to so-called Liberation Day, the announcements of these incredible tariffs, and the market tanked. The bond market was affected, and then it's recovered. And the stock market's still not up a lot for the year, but we've had positive earnings. We had very negative GDP numbers in the first part of the year, but again, that was the way it's calculated. Gross domestic product. It's calculated on the domestic numbers. So if we are having a ton of imports coming in, as we did earlier in the year, to try to front run the tariffs, it makes the GDP numbers look worse. So now we've had 3% GDP growth. And again, it's a little bit of a mathematical issue because we've had a drop in all of these imports. So you have to read, why are these numbers happening? And so we still have ways to go to get numbers that are going to point to one direction or another. Now, I'm going to get into one of the big issues, and I will not be silent on this, nor should anybody. We had these bad job numbers come in, which was a revision, and there is nothing nefarious about it. They had incredible job cuts. The Bureau of Labor Statistics. This data gathering is incredibly labor intensive. And that's part of the reason that these revisions were so large. Another reason is, and this is published information, the response rate from businesses that they rely on just keep going lower and lower and lower, down to 40%. And so it takes more effort to get data, and then the data keeps coming in later and later. So there was nothing nefarious. These revisions are normal. The size of the revisions were not, but it's completely explainable. So here, Trump makes this charge. Here it is. This is from NBC News. Taking to Truth Social, he attacked Erica McIntyre, the commissioner of the Bureau of Labor Statistics. He claimed that the country's jobs reports, quote, are being produced by Biden appointee and ordered his administration to terminate her. Quote, we need accurate jobs numbers, Trump wrote. Quote, she will be replaced with someone much more competent and qualified. Important numbers like this must be fair and accurate. They can't be manipulated for political purposes, end quote. So clearly this was a dig that this is political, that these numbers are doctored, fabricated, politically motivated against him. There's absolutely no truth to that whatsoever. There's no evidence. And when the media is reporting this, they're saying that Trump claimed without evidence. So this is something that you see like in third world countries. And again, we seem to be falling down this path of a new low. It is absolutely the wrong thing to do. It will reduce the confidence in these numbers. So one of the things I want to say is you can't get away with this forever. And this is from another, uh, I guess, a financial blogger, Sam Rowe, that I follow, who I mean, I have some very strong conservative tendencies for sure, but it's strong and I like old school stuff. But then I'm appalled at so much that's happening in Trump world, and it's like, and there's always excuses for bad behavior. This is from somebody who I think is definitely on more of the Trump team than not, especially because of cryptocurrency. And that's logically consistent. If you're a big cryptocurrency fan, you favor less regulation. And there was a reason to support Trump. Here he writes a note about Trump firing the BLS, the Bureau of Labor Statistics Commissioner. When it comes to economic data, it's very difficult to hide the truth. So I want to emphasize that you can't just look at one statistic and you can't just look at it in a vacuum. A lot of what I've just said here is you have to look at trends over a long term, all these different data points. And if you have certain trends and all of the other points, and then you have some fake number that comes out from a crony, let's say somebody who's just been appointed to say something, then it's not going to be credible and the market will react that way. Now, the general public might not be able to tell the difference, but the markets, the banks, the economists, the legitimate economists will. So here he writes, I have no reason to question the integrity of the former chair and the work of her colleagues at the Bureau of Labor Statistics. And we can't rule out that the possibility that the replacement will continue to do the right thing and do a good job. But if Trump intends to somehow affect the collection and reporting of data in his favor, he's got a difficult task ahead of him. Because if this data starts to conflict with all of the other data, people will stop paying attention to it. And of course, then it becomes not credible. And hopefully it would get fixed. So he says that seems unlikely for now. Well, we've said that about a lot of things not being likely. So also just to emphasize how wrong this firing was for that reason, that the numbers are cooked, that this is political. that he's going to put in his own people. Here's a quote. Uh, Quote, the totally groundless firing of Dr. Erica McIntyre, my successor as Commissioner of Labor Statistics at BLS, sets a dangerous precedent and undermines the statistical mission of the Bureau. That was by William Beach. He posted on X. He was appointed the BLS commissioner by Trump in the first term. He served from 2019 to 2023. So Trump's former appointee there has blasted this firing. So stay tuned on that. Lastly, this is just entertaining. um, I kind of make fun of a particular so-called economist, First Trust Portfolios, Brian Westbury. He sends out this Monday morning outlook, and it's he calls it an economic research report. I mean, this is a major company, First Trust. They have all sorts of investments that are all approved for us to use. He is definitely, without trying to show it, I can see a diehard Trump fan, small government fan, small spending fan. And here, it's just kind of funny to read some of these things. The title of the report is Everything is Political. Be Careful. And then he goes on to make all of these hypocritical political comments. So he starts out, it certainly seems hyper politicalization has come to every piece of economic data. First Wednesday's GDP report. So he's starting off on something totally different than the firing of the head of the statistics at the BLS. The GDP report, some people were very excited about it because it was so positive, 3%. To his credit, he's saying, no, it's a statistical anomaly because it was so negative because of all of the tariffs and the front running of the tariffs, the way it's calculated, what I just said. And that's all true. I agree with all of that. But so here, he gets into this one-page report talking about the quote, the widespread negative reaction to the jobs report, and evidently, that's my emphasis, evidently cause for Trump to fire the head of the Bureau of Labor Statistics. There was no evidence at all. The silence is deafening on this. Anybody who's talking about the firing of the head of the Bureau of Labor Statistics should point out that this was politically motivated, and he said so. This wasn't motivated because of competence or because of just concerns about somebody doing a poor job. This was politically motivated. So it's like hot kettle black here to say that people are interpreting these numbers politically. He even goes on to say here towards the end, whatever your view on immigration enforcement, we're talking about the job statistics again, immigration enforcement, not immigration policy, but enforcement. A slowdown in jobs held by foreign-born workers is exactly what we should expect. There's a lot of underlying analysis of these statistics, which only come out into the headlines. But if you look at the job growth and what is happening, there's no question that there is definitely job loss from people who were born in foreign countries. So at any rate, I point that out, the political language on some of these things for people who are trying to say, oh, other people are making things political, pot kettle black. So those are my comments. I've said half an hour. If there are questions or comments, we're putting in some of the points here in the end. There's a handout that you can download in the chat on the one big beautiful bill. So let's hear the question. When economic stability is in question and the stock market no longer reacts the way it did earlier in the year to tariff and other news, does that suggest there's less significant risk of volatility? With stock price to earnings valuations currently higher than average, I'm wondering if it's still a safe time to enter the market. I think the chances of volatility are still very high because what's happened is the market, it's like the taco trade where Trump always chickens out. The idea was when the market reacts badly enough, especially the bond market, Trump has backed off on those tariffs. And so the market has started to discount that and has not reacted to every proposed tariff that comes along. Now, what does that mean? When we had Liberation Day, the market reacted very badly and we had a meltdown. Then he backed off. So, is there a chance for similar volatility? The answer, in my opinion, is yes. That now these bouts of volatility are often short lived. That doesn't mean that you should necessarily get out of the market. It depends on your risk tolerance. We try again to manage this risk by having managers who will get out of the market, and we even blend them because sometimes, frequently, one does much better than the other. It could be that they do better on the upside at capturing growth, or they do better on the downside at avoiding losses. But that's how we try to control that, along with other things. But I think that there is still risk of volatility. It could be something news driven. There's absolutely no question that the I think over the next several years, when everything is policy driven, not just a normal economic cycle, there is definitely risk of volatility. And in terms of the stock price valuations, that's another good point. Um, some people were arguing that the correction that we had from they call it the Trump tariff tantrum earlier in the year was somewhat justified because valuations were already so high. It is very normal that we get a 10% correction. And that's I like that term, a correction. Things just go up and up and up. Then there's a correction. If there's no underlying problems, they start the march up again. And that's normal. Now, if it's a more severe or if it's longer term, that becomes an issue. That's why we look at some of these statistics to see, what's really going on, checking under the hood. Are there real one of the real issues here I see is stagflation. That is the risk that we will have rising inflation and a slowing economy and worsening employment. And that's not something we've had in a long time. So, that's like the worst of all worlds. So, but still, we have had, those GDP numbers. We have to, get more data. We have had good corporate earnings. So, there's still, good growth. So right now, we're like, staying the course on things, but be prepared for volatility. And I think there's still a chance there. Are there any things I need to do now with my planning to address the tax changes? The only thing that I think of that we come across is people who are charitably minded, who want to get a deduction for contributions, yet they're not going to be able to because they can't itemize. We have something donor advised funds. This isn't for most people. You'd have to really make a large contribution, but then you would be over that exemption. And so then you will be able to do a deduction. So somebody may fall into that category. I think the most important thing to do is still just the standard, tax planning, take advantage of tax deferral, save into tax deferred accounts, 401ks, IRAs, do the planning that you're not taking out too much money from those tax deferred accounts so that you get bumped into a higher tax bracket. Be aware of the tax effect of things. If you have a higher income, it affects your Medicare Part B premiums if you're getting Medicare. Also, your Social Security taxes. We want to make sure that people are doing the required minimum distributions that they have to do by the end of the year, and those kinds of things. We had one case where an estate was not properly processed, and we had a client who got a huge tax bill, and this was from like 3 years ago. And we looked at this, and I felt a moment of pride that like this would not have happened here if we were dealing with somebody who passed away. A whole IRA got cashed out. We know to do inherited IRAs, or if that's not an option, that this was the estate was named to the beneficiary, or there was a trust designation that blows it up, that you still withhold the taxes. You don't distribute it to all of the beneficiaries. And then 3 years later, get a letter from the IRS. Oh, you owe $49,000 in this case and have to come up with that money. You do the final estate taxes. You work with the accountants and the professionals, and withhold that money and then pay the final taxes and then return the money, or distribute the money to the heirs. So I would say normal tax planning. That I don't see some of the other, there may be some things for business owners in there that might involve some other tax planning. We always have to say we're not accountants, we don't give tax advice, but you can definitely, if you fall into one of these other categories, like you're trying to do charitable giving or you're a business owner, then you should work with your tax professional, your CPA, maybe to see if there's something there to take advantage of proactively. So, and that's it. I think if there's nothing else, we may be, yeah, feel free to reach out, schedule some things. We'll see you next time on Treece Talk. We're going to be talking about wealth.com, and that is a system that we have approved by our broker dealer, Cetera Advisors, where you can do legal documents. And if we like attorneys, nothing against attorneys. But a lot of people are not getting their documents done. And this is a much cheaper way to do it, and you can do it yourself. So we're going to introduce that in 2 weeks, and then there will be a lot more information on that. This is a huge program. It's brand new, again, approved by Cetera Advisors. So we definitely are going to be offering it. There's a cost for it. We have a big expense for it, but it's still going to be a big savings over going to an attorney if you're not doing that on your own. That's it.